Most traders chase win rate. They see a strategy advertised with 80% winning trades and immediately assume it's an edge. They see a strategy with 30% winners and immediately assume it's broken. The math says the opposite is often true. Edge is expectancy, the average dollar outcome per trade, not win rate. A strategy with a high win rate but tiny winners and large losers is negative expectancy. A strategy with a low win rate but huge winners and small losers can be massively positive expectancy. Today, the 4 numbers that define your real edge, why win rate alone is a misleading metric, and how to evaluate strategies the way the math actually works. Here's the formula. Expectancy equals the win rate times the average winning are multiple, minus the loss rate times the average losing are multiple. Anything positive means the strategy makes money over time. Anything negative loses. Win rate is just one of the 4 numbers. A high win rate with small winners can still be negative expectancy if the losers are even slightly larger. A low win rate with massive winners can be hugely positive expectancy even if you lose 7 out of 10 trades. The math weighs all 4 inputs equally. Chasing one of them in isolation is chasing the wrong metric. Watch this in a synthetic curve. A trader runs a strategy with 70% win rate, looks impressive. Average winner 0.5 R, average loser 1 R. Expectancy calculation. 0.7 times 0.5 equals 0.35 R won. 0.3 times 1 equals 0.3 R lost. Net expectancy 0.05 R per trade. After commissions and slippage, basically break even. The strategy looks great by win rate, the spreadsheet looks fine, the actual P&L is flat. The win rate was the trap, hiding the fact that the small winners couldn't outpace the proportionally larger losses. Here's the fix. For every strategy you evaluate, your own, someone else's, a backtest, a course you're considering, calculate expectancy from the 4 numbers. Win rate. Average winner in R, loss rate. Average loser in R, plug them in. Above 0.3 R per trade, the strategy has a real edge. Above 1 R per trade, it's exceptional. Below 0.2 R, the edge is too small to overcome real-world costs. The number above 0 is the dollar expectation per trade. Multiply by trades per year for annualized expectation. That's the metric to evaluate. Win rate alone tells you nothing without the R numbers attached. Now the example most traders misjudge. A trend-following strategy with a 30% win rate looks broken at first glance, but the average winner is 5 R and the average loser is 1 R. Expectancy calculation. 0.3 times 5 equals 1.5 R won. 0.7 times 1 equals 0.7 R lost. Net 0.8 R per trade. That's a strong edge, 16 times stronger than the 70% win rate example. The strategy loses 7 out of 10 trades and prints money. The win rate was scary, the expectancy was beautiful. This is why famous trend-following hedge funds operate at sub 50% win rates without anyone batting an eye. The math works because the R numbers work. In practice, log all 4 numbers monthly. Win rate, average winner R, loss rate, average loser R. Calculate expectancy. Compare to last month. The trader optimizing for expectancy can sacrifice some win rate to bring in bigger winners or smaller losers. Both improve the formula. The trader optimizing only for win rate often does the opposite. Takes profit early to lock in winners, smaller average winner, and moves stops to avoid taking losses, larger average loser. High win rate, collapsing expectancy. Same trader, opposite outcomes. The number that pays bills is expectancy. So win rate is one ingredient in your edge, not the edge itself. Edge is expectancy, win rate times average winner in R, minus loss rate times average loser in R. A 30% win rate at high R can crush a 70% win rate at low R. Track all 4 numbers, optimize for expectancy, and stop chasing the vanity metric. Subscribe for the full method and trade your own plan. Education, not financial advice.